Tim, Apple making moves 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, President Trump ramps up tariff threats with India, pharma, and chips in his sights. A mixed bag of earnings adding to worries about the impact of tariffs and a slowing economy. Plus a Bloomberg scoop. OpenAI eyes a massive share sale as the AI showdown heats up. Katie, what are you watching?
I'm keeping an eye on shares of Disney right down, only about 1% lower in the pre-market. They were higher, though, initially after they raised full-year guidance on strong activity in parks and streaming. But conventional TV revenue disappointed. It also deepened ties with the NFL. We'll get into all the details coming up, Matt.
Yeah, ESPN, a big story for a lot of people watching. President Trump will announce that Apple is going to commit to spend another $100 billion on domestic manufacturing. That's the latest pledge by the tech giant to increase U.S. production of its products as it seeks to avoid punishing tariffs on its flagship iPhones. You can see the shares up 1 2/3% in the pre-market, Katie.
Yeah, interesting movement there. Let's bring in Bloomberg Tech co-host Ed Ludlow, who joins us now from San Francisco. Ed, there is an embarrassment of riches when it comes to tech news this morning. I want to talk about Apple, but I want to talk about AMD. We think back to what we heard from the company, a little bit of disappointment, and you can see that in shares lower by about 5% right now in the pre-market.
Yeah, so in the quarter that they just reported, their data center business is the key thing to watch. It was strong, but that's in part because even if there's some volatility around GPUs, AI accelerators that go into data centers, particularly around China, their CPU business really held up. The thing that the market's nervous about is that we know the situation with China has changed. They have a specific chip for that market called the MI308. And what they did not tell us was a prediction or an outlook of the pathway for sales to resume of that product. So we know where the White House and the administration stands, but what we don't have in their outlook or any communication from the company is what happens next. Because some of the most bullish names on the street think that China can represent billions of dollars of revenue for AMD next year and go to one extreme, but the company did not communicate that.
I want to ask about Apple.
Please.
The other day I asked Mark Gurman how many iPhones will be made in the U.S., and he laughed at me. So I guess that's not the goal. But it does look like Apple's going to be spending well over $500 billion in the U.S. in the next 4 years. What do we know? What's new?
So this is huge in technology, and this is what you need to know. It's a $100 billion additional spending on top of $500 billion that Apple had already announced to spend over the next 4 years. The money was very specifically targeted. There will be a server manufacturing facility. A lot of that money will go to its supply base within the country. There's also some kind of training element to it as well. Apple has been really emphasizing how much commitment it has to the United States for semiconductor production. They keep giving numbers of chips that are coming out of US fabs. That's important. But what this doesn't answer, remember, this is Bloomberg reporting citing an anonymous White House official. We think the answer will come later today. This is an expansion of a financial commitment to the United States from Apple, but it is not going as far as to say we're going to manufacture the iPhone in America. That's very separate and very distant and seems unlikely still.
Well, you think back to earlier this year when the president warned that he would hit Apple with a tariff of 25% if it didn't move manufacturing of the iPhone to the U.S. I mean, this is political in nature. I think it's pretty safe to say that openly, Ed. So even if they don't fully move all of their production of the iPhone to the U.S., which many agree would be a little bit impossible here, at least this is an olive branch which might keep them in the administration's good graces.
Yeah, since the turn of the year or the inauguration, Tim Cook has not been the president's best buddy. Jensen Huang, NVIDIA CEO, has been the president's best buddy, essentially. And it's been fractious, and the stock in the first half of this year, Apple I'm talking about, traded reflecting the risk of the president's attitude towards supply chain tariffs and Apple's move or not to manufacture the iPhone in America. The vast majority of people that we speak to on Bloomberg Tech and anything that you read would suggest that that idea, manufacturing a handset in this country, is highly unlikely, not because you can't build a facility to do it, but you have to build cities worth of supplier facilities around that. That's the picture you see if you go to mainland or Greater China near a Foxconn facility. You have basically a little city with all of the core component supply base around it. And America doing that, along with a lack of skill set in tooling and that level of manufacturing, that's the main barrier right now.
By the way, Ed, speaking of $500 billion, Shirin Ghaffari, after the killer story on reverse acqui-hires yesterday with Kate Clark, comes out with some news last night that OpenAI is going to raise even more money at a $500 billion valuation. This just continues to grow and grow.
Yeah, OpenAI has a lot of momentum. There's a key point and key distinction here that this is a tender or secondary offering. So OpenAI is going to allow some employees and early investors to sell their shares. In other words, OpenAI doesn't raise fresh capital and doesn't issue any new equity. But this mechanism allows to, in the context of talent wars, have long-serving employees get some liquidity of their own. The jump is to $500 billion valuation from $300 billion when they did their last primary, when they did raise fresh capital and issue new equity to new investors. But that is a hell of a jump. And we have some other sort of what I would call soft data coming out of OpenAI on weekly active users for ChatGPT, their place in the enterprise market. But clearly, this creates a market. It creates liquidity on a liquid private stock. And I imagine that people will be talking about this for quite a few days to come. Yeah,
it's an amazing story. Ed, we'll hear more about it, I'm sure, on your program. Bloomberg Tech's Ed Ludlow. Don't miss his interview, by the way, with AMD's CEO, Lisa Su. That's at 11 a.m. New York time when his show kicks off. But there will be a lot of coverage, I'm sure, on Apple. There will be a lot of coverage, I'm sure, on OpenAI. Bloomberg Tech is a show you have to watch if you invest in this sector. Let's get now to Disney. The company inked new deals with the NFL and posted a strong performance from its theme parks and streaming business. But, as Katie said earlier, it's battling a tough climate for movies and traditional television. Geetha Ranganathan, media analyst for Bloomberg Intelligence, joins us now. And Geetha, I continue to be impressed by the theme park business. This is a juggernaut for Disney.
It absolutely is, Matt. I mean, it brings in 55 to 60% of the company's total profits. So it really is the bread and butter of the business. And remember, coming into this quarter and actually coming into this whole year, there were so many overhangs, right? There was this whole question about, macro uncertainty. We had a new theme park from a competitor, which is Comcast's Epic Universe, opening in Florida. And so there were concerns about whether, that would kind of cause a slowdown at Disney's theme parks. And we've seen them kind of really demonstrate some excellent resilience here. So if you just look at domestic theme park profitability, it jumped 22% in the quarter that they just reported. And again, remember, they said that, they're going to have more and more attractions come on board. They have 2 more cruise ships coming a little bit later this year. So this segment is really poised for very strong growth for definitely fiscal 2026 and beyond.
Absolutely. Appreciate the context on the theme parks. It feels like everyone just wants to talk about streaming, though. Streaming overall looked very strong. You do point out in your reaction piece, though, that full-year streaming profit guidance of $1.3 billion, though, points to a modest sequential deceleration in the fourth quarter. How big of a worry is that? When you think about how Disney is positioning streaming, which seems to be the future here, how much confidence do you have in their trajectory?
A lot of confidence, Katie, and that's just because, they have, obviously one of the best content pipelines here with their movie studio, with all of the different TV shows that they have. Yes, we've seen a little bit of, in terms of trends at the Disney Plus subscriber trends. They have been, there's been a little bit of a slowdown, but I think that is stabilizing. But I think what we're really kind of looking forward now is this integration of Hulu onto the Disney Plus app. And what that's going to do is not only does it kind of position this as a one-stop shop in terms of streaming, but it also helps them kind of remove a lot of duplicative costs, whether that's, marketing, whether that's, all of this, new AI or getting more personalization features, getting more enhancements. It really kind of enables them to do that in a much more efficient way. And so, yes, they did increase profit guidance for the entire streaming unit from about $1 billion to $1.3 $1.3 billion. But I think, they're being a little bit conservative. I think we can continue to see a little bit more upside as they kind of, execute on the integration of those apps.
All right, Geetha, really appreciate the context there. That is Geetha Ranganathan of Bloomberg Intelligence talking us through those results that we got from Disney. Matt, I just want to quickly meditate and look at the one-year chart of Disney because I find it really inspiring. You think about the bounce back that they've seen since April, just a roller coaster that's going up over the past year, higher by about 32%, outperforming the S&P 500. A lot of that just came in the last few months, though.
Yeah, it's pretty impressive. To me, the big takeaway from this story is that you're no longer going to need, I hope, a cable subscription to watch NFL football, right? Now, finally, their apps, their over-the-top product like Disney Plus or ESPN Plus is going to be able to show me the football that I need.
That's not huge for me, but I'm really, really happy for you. And I'm
Thank
sure
you
a lot
so
of people watching are also psyched about that. Maybe that explains the excitement in the shares. But let's take a quick check on futures at the moment. We're about 20 minutes away from that opening bell. You can see a little bit of a lift in the S&P 500 right now, higher by about 0.2%, a little bit less if you take a look at the NASDAQ 100, higher by about 0.2%. The little guys are your laggard today, but the Russell 2000 still higher by about 0.1%, Matt.
Some more movers on our radar. Snap, as in Snapchat. Apparently, the kids still use this. Reported a slowdown in advertising revenue growth due to a technical issue with its ad buying tools. Mandeep Singh told me they have 500 million daily active users. That seems impossible, but apparently
there's a lot of high schoolers out there.
Apparently they have 98 million in America, in this country.
Yeah.
Which seems like a lot.
Seems like a lot, but you can see the shares down mightily right now. When we were checking this morning, we were surprised to see the market cap is almost $16 billion. Obviously, that number is going to be chopped a little bit today. Let's talk about McDonald's, though. McDonald's sales picked up last quarter and says that they will accelerate in the current quarter. McDonald's shares up 3.4%. A lot of strength overseas as well, in the U.S., but more so internationally.
It's difficult to hear about that so early in the morning.
Well, we have another mover for you.
Novo Nordisk sales showed the weakest growth in 4 years as the company loses ground to Eli Lilly in the U.S. market for obesity medicine. So it makes sense to see McDonald's shares up and Novo down.
There's your pair trade.
Yeah, exactly. But I guess people are just using terzepatides, as in Zepbound and Mounjaro, more often than Wegovy and Ozempic.
Yeah, absolutely. We know that Novo has a lot of idiosyncratic issues right now. They appointed their new CEO, and he has a big job ahead of him. And ahead for us, President Trump ramps up his tariff blitz. We'll bring you the latest details next. This is Open Interest.
Get now to high interest. Look at what's making headlines around the world. Apollo is agreeing to buy a majority stake in the hyperscale data center developer Stream Data Centers. Alternative asset managers like Apollo have been spending big money on data centers as the rise of AI spurs power demand. Morgan Stanley says the capital expenditures on AI could exceed $3 trillion in the next 3 years. You can see Apollo shares after the gain yesterday up again today, but they've had a rough year. Rivian is softening its forecast and warning of mounting losses thanks to President Trump's tariffs and changes to the EV tax credit structure. The levies are expected to raise costs by a couple $1,000s per car in the second half of the year, according to the CFO, and they're only going to make 40 to 46,000 cars, like hand making them one at a time. The shares down more than 5% in the pre-market, and they have already been crushed. Health Secretary, hi Katie, Robert F. Kennedy Jr. is canceling nearly $500 million of grants and contracts for developing mRNA vaccines, the vaccines that fight respiratory viruses like COVID-19 and the flu. The changes also include the cancellation of an award to Moderna for a bird flu shot. So they're going after those vaccines just like you kind of knew that they would, Katie.
Well, to that point, Matt Miller, President Trump is ramping up his tariff threats, saying that announcements on chips and pharma, to your point, those tariffs are coming soon. Let's discuss with Bloomberg's Washington correspondent Tyler Kendall. And Tyler, this is what the president has said he's going to do, but it feels like it's just very incremental at this point. That certainly seems to be the read from the markets when you take a look at the reaction function to these different announcements. So give us some context here. How imminent is coming soon in actuality?
Yeah, definitely, Katie. I mean, there is a lot of perhaps ongoing uncertainty when it comes to the timeline, because we have heard for really months now that some of these sector-specific tariffs could be imminent. And we know typically these Section 232 investigations could take an upwards of 9 months to complete. But the White House does say that they appear to be closing in on some sort of announcement. And in fact, we did get a little bit more clarity, at least on the pharmaceutical end, on how those tariffs could be structured. The most clarity that we've really gotten in recent weeks, which perhaps could point us towards an announcement. President Trump saying that those tariffs are going to start out at a lower rate and then build up from there. He said after a year to a year and a half, they could reach up to 150%, with the ultimate end goal being 250% pharmaceutical tariffs. The idea being that it's going to take time to reshore production and move those supply chains. Because Matt and Katie, we have to keep in mind here, these Section 232 investigations, they're investigations into the entire supply chain. So that means that once tariffs are announced, they could be on those finalized pharmaceutical products, but they could also include the ingredients too, which only further complicates how these private companies are looking at restructuring their supply chains.
Tyler, I found the India tariff fight particularly fascinating because, you know, when Russia invaded Ukraine, the EU and the U.S. put sanctions on Russian oil. But we all knew they were going to keep selling it to India. India would refine those products and then sell them back to Europe because Europe needs that oil. But President Trump seems to be finally nipping that in the bud, and he's gotten help from Saudi Arabia and OPEC. As they continue to raise production, he can squeeze down on Russian oil even more. Does anybody else see it like that?
Well, Matt, actually, it was really interesting because our analysts at Bloomberg Economics put out some data which shows that India takes about 37% of Russian exports. And at the end of the day, these barrels are expected to just be dispersed elsewhere in the market. So our analyst read is that this is actually more about leverage in the trade negotiations more than anything else. At the same time, though, we know that Russia is trying to stave off any sort of economic penalty, and our own reporting indicates that there could be a potential concession put on the table here to try to back President Trump off this so-called secondary tariff threat. People familiar are telling Bloomberg News that Russia could be prepared to offer an air truce to try to get ahead of these secondary tariffs, though we should say that the understanding is that Russian President Vladimir Putin is not looking for a more definite ceasefire. This would just be an air ceasefire to try to get some sort of reprieve there, as Special Envoy Steve Witkoff is in Moscow for those negotiations. But really, when it does come to India, President Trump said that over the next 24 hours, we could see some sort of update on the so-called secondary tariffs. So it's something that we're watching closely, as the White House does appear to double down on this, and what else that could potentially mean for those other importers like China, for example.
Well, just quickly here, Tyler, another thing we're watching very closely is whether or not we get a decision from President Trump on who that next Fed governor might be after Adriana Kugler vacated her seat. We heard from the president yesterday saying that his pick could come by the end of this week. What is the latest on that horse race?
Right. Well, President Trump says that he has 4 names in mind. He named the top 2 that we've already been discussing, of course, for at this point weeks. The 2 Kevins, former Fed Governor Kevin Warsh, as well as NEC Director Kevin Hassett, which would mean that there are 2 additional ones. He did appear to rule out Treasury Secretary Scott Bessent, saying that he himself has said that he is not interested in the job and he wants to stay leading the Treasury Department. Really, one of the key things that we're going to be looking for is indications on whether or not this is perhaps a more permanent appointment, since we know that Kugler leaving her seat that was originally expected to vacate in January could lead to perhaps a more longer term appointment down the line on the FOMC.
All right, Tyler, thanks very much for your coverage. Tyler Kendall there in Washington on top of it all, and there's a lot on top of which to be. Coming up, markets are ignoring recession risks, according to a Goldman macro trader, but they just keep barreling on. We'll discuss that with Jim Caron of Morgan Stanley next. This is Open Interest.
Well, Goldman Sachs says that market momentum is getting, quote, irrational as Wall Street ignores recession risks. In a note to clients, a macro trader wrote that investors are too short-sighted due to ever-changing economic and geopolitical forces. He believes that investors are likely to disregard a possible labor market slowdown, instead focusing on strong liquidity as well as structural growth themes. Let's bring in Jim Caron. He is Chief Investment Officer of Cross Asset Solutions over at Morgan Stanley Investment Management. Great to see you in person, Jim. Let's dig into that a little bit because, strong underlying growth momentum doesn't seem like necessarily a bad thing to focus on.
No, I think there are two sides of the risk. And the risk to the upside is a risk, and like any other risk, it needs to be hedged. That's my tagline. I always talk about that. So I don't think that the markets are ignoring recession risk. I believe that the markets understand that there's a healthy component of downside risk possibility, but there's also a healthy component of upside risk possibilities too. And so if we get through this patch of data that we're likely to go through in August and September, and people are going to start talking about stagflation and valuations and equities, what if we get through that? And what if that turns out that Mary Daly's correct, that inflation's not really permanent, we're going to get through this? Then what we're likely to see in the fourth quarter and into the beginning of 2026 is all of the positive benefits from that one big beautiful bill act and accelerated depreciation, CapEx, and everything else. And there could be a lot of upside. And you're starting to see hints of that in earnings data right now.
All right, Jim, we're going to keep you with us through the opening bell. Jim Caron with us this morning. Check on futures. We're looking at some gains. The opening bell at the NYSE and the NASDAQ next. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. Quick check on futures after stocks were under pressure yesterday. We're looking at the green again today, just about 0.2% on S&P futures, a little bit less or the same on NASDAQ futures. We had kind of a mixed bag of earnings, and I think traders are waiting to see what happens today in terms of the tariff threats that we got yesterday. You hear and see the opening bells. So exciting down the New York Stock Exchange. BlackBerry ringing, as if we needed another parallel to the internet bubble. BlackBerry ringing the opening bell. I loved my BlackBerry device.
I had a pink one in college.
They don't do that anymore. Now they provide solutions, right?
Of course.
Down at the NASDAQ, Terra is a SPAC, and they're looking to get into the agribusiness, brought the whole family, which is fantastic. They've only been trading for a little bit, but they're still doing better than BlackBerry.
Okay. Well, let's talk a little bit about Disney. We've been watching Disney shares, but I'm actually going to talk to you about Apple. Scratch that. Apple. President Trump said that he will announce that Apple will commit to spend another $100 billion on domestic manufacturing. That is the latest pledge by the tech giant to increase U.S. production of its products as it seeks to avoid punishing tariffs on its flagship iPhones. We were talking about this with Ed Ludlow, that full manufacturing of the iPhone in the U.S. is probably a pipe dream. But in terms of staying on the administration's good side, this goes some of the way towards that. You can see the shares of Apple currently up about 2% right now, Matt Miller.
All right, watching AMD as well after it put out earnings yesterday. It came out with an upbeat forecast, but the company was unable to give a clear outlook for resuming sales in China, which is concerning analysts on the street. You can see the shares down 6%. They had been outperformers. I will say AMD was up like 46% year to date, and NVIDIA was only up 36% this year to date. So they're doing a little bit better even with today's losses. Still with us, Jim Caron, Chief Investment Officer of Cross Asset Solutions at Morgan Stanley Investment Management. Great to have a cross asset guy in here. That's Katie's day job.
That's
she
true.
works on the cross asset
team reporter.
Desk over on the other side of the office. When you say you should be hedged for downside risk, and I don't think anyone's expecting like a 50% chance of recession, but 25, 30 doesn't seem unreasonable. How do you do that?
So look, there's a couple of ways. Number one, your first line of defense is diversification, right? And everybody talks about that. So owning a healthy amount of decent quality bonds alongside your equity. But what you have to understand is on your equity side, the part of the market that's generating the returns and the growth is that higher risk, higher beta component, which is mostly the tech, the Mag 7 that everybody discusses. So on the other side of that, what you really need to start to think about is look at things through a global lens. And that's what we do at Morgan Stanley Investment Management, is we tend to think about how do we hedge our growth exposure with value? But does it have to be value in the U.S.? It could be value in Europe. So what we've done is we've looked at growth sectors in the U.S. and we've hedged that with large cap value, but in Europe. You get the benefit of an appreciating euro versus the dollar, and so far this year, the European equity markets have actually done really well. So both have actually worked. The growth component in the U.S. has worked, and the value component within Europe has also worked. Bonds, you're getting the coupon. You're in. Bonds are doing very well on a risk-adjusted basis. There's nothing wrong with holding a decent amount of bonds in your portfolio. It's just that it doesn't seem that they're going to generate high single-digit or low double-digit returns. I think it's a coupon game that you're playing in bonds.
There's a lot to focus in on there. So let's talk a little bit more about European equities. I'm wondering how those conversations with your clients sound like, because there's so many investors out there that are trying so hard to ignore what's going on in Europe right now.
So it depends where your client is. And what I find, ironically, is that most of my European clients are the most negative on Europe. Most of the U.S. clients really just see it as, oh, we have an underweight, it's doing well, we need to get back up to market weight, how much Europe should I actually own? What I think is really being missed by the market is the power of deregulation that is likely to come through in Europe. So we talk about this stimulus and this, this trade deal that Trump has done and the $600, billion potentially from Europe. It's not so much about an investment that just comes in from the European Union as like, here's the cash, here it is. A lot of it comes from deregulation, which doesn't cost the European policymakers anything. All they have to do is they just have to take their hands off the means of production a little bit, allow the free markets, allow the capital markets to work within Europe. And what you're likely to start to see is enterprise value creation. Enterprise value creation in Europe, that's a big deal. So that makes us positive. But within Europe, we are very specific about the mid-cap DAX because we like Germany, and also the European financials because we think that European financials are the early winners. They've been doing well. Yep. We think they're going to continue to do so.
And they're doing it, by the way. They're giving you a much lighter touch in Brussels. The Germans, of all people, are finally spending money, right? And there was a great story in the Terminal this morning about another $100 billion fund that the Germans are investing in. It's like a sea change there. I wonder about the bonds part of it, though, because are we still looking at 420 on the 10-year? Like, it's unbelievably low yields, at least when I think about the fact that baby boomers aren't saving money anymore. The rest of the world, again, is maybe going to look at the euro instead of the dollar when they do bond issues. We don't really have as much Fed independence as maybe we had last year, and if we don't like stats, we just fire the statistician. Like, all of these things are bad news for rates, right? It's got to put upward pressure on rates.
It should, but there's a lot of money that's out there. So where does it go? So if you're going to hedge your equities, and bonds are a really good candidate to do that, there's a lot of money out there, and the supply of bonds is relatively not in government sector. In more the corporate sector, the supply is really, really low. So effectively, there's a lot of crowding into the bond market because of the high levels of cash and also the significant amount of money growth that's taken place over the last several years. This is all very supportive. The other thing, though, too, is we have to start to think about these inflation numbers. We have one coming up next week. It might be 2.8% in CPI on a year-over-year basis. But I think those numbers are pretty much peaking out somewhere around that 3% level. And if it does start to come back down, people then start to say, well, maybe I should start to add some duration to my portfolios to potentially capture some extra returns. If the Fed's going to cut, which it seems like they will, this could be a place that not only is a reasonable hedge in your portfolio, but it could also be an attribution to return as well.
All right, Jim, we got to leave it there. It's always great to speak with you. Thanks for joining us on set. That is Jim Caron of Morgan Stanley Investment Management. Let's talk a little bit more about Disney. I was really eager to do that at 9:30. We're going to do that right now, though. Disney's earnings, they beat, but the shares are falling as a tough climate for movies and traditional TV overshadowed growth at its parks and streaming business. Let's discuss with Wolfe research analyst Peter Supino. He has an outperform rating on the stock with a price target of $139. Great to have you with us, Peter. Let's talk about what we're seeing right now, because it seemed like there was a lot of good news when it comes to streaming. We know that Disney has been positioning that as the future of the business. With that in mind, Why do you see this drawdown right now in shares?
The stock price reaction today doesn't make much sense to us. Disney reported objectively good results, increased its guidance. The only real explanation we can come up with that's fundamental is that Disney withdrew its intention to continue providing subscriber results. So they're mimicking or following Netflix lead by withdrawing that form of disclosure beyond 2025. And so investors are probably uncomfortable with that. Otherwise, we think Disney was somewhat crowded before this report, and that the guidance increase that they reported was generally expected.
Well, Peter, I know you have an outperform rating on shares, but you mentioned investors are uncomfortable with the fact that they're not going to be disclosing subscribers. Are you uncomfortable with that? How much harder does that make your job of analyzing this company?
So I think it's great. And the reason I believe it's great is because the period of time when it was appropriate for Disney and the industry to be reporting granular data to Wall Street about subscribers and ARPU was the period of high growth in which valuation multiples needed to correspond to those perspectives on future growth. Today, in the United States, streaming is a very saturated, mature business for those households that receive their TV that way. There are almost 90 million US subscribers to the sum of Disney Plus and Hulu. It's almost as big as Netflix in the United States. And so it makes sense to run the business differently and with an eye towards balancing units and price and margins. We're into a different era for streaming.
But Peter, you're an analyst. I mean, what other data would you like Disney to hide from investors?
It's
like,
interesting.
why would you want less transparency? Why not
it's
every day,
It's a great quip, but you should look at the Disney earnings release and you'll see an enormous amount of information and granularity, much more than you'll see from other industries. It's our view that generally speaking, the media and telecom coverage that we have at Wolfe Research reports more KPIs and more detail than most conglomerates across the S&P 500, and sometimes it can be counterproductive.
Appreciate you playing along there. It does seem a little bit unintuitive, but I hear what you're saying. Let's talk a little bit about conventional TV, because it seems like that is the weak spot here when you take a look across the business lines. I mean, it seems like this is an industry-wide issue. Is there anything that Disney can particularly do here? Any levers that they can pull, or do they just have to be content with the overall environment?
Well, it's extremely difficult to have any exposure to the linear TV bundle. We wrote recently that the only things that are certain in life are death, taxes, and the decline of linear television. And so the good news for Disney investors is that everybody who follows this stock on the buy side or the sell side has underwritten, a steady, permanent decline of linear TV in their earnings model.
We hope TV has a long, long life. And we hope you come back and join us, Peter. Wolfe Research analyst Peter Supino there talking to us about Disney. A lot of moving parts here, and it's going to be a stock we're watching definitely all day long. Coming up, Ryan Reynolds' ad tech company is out with its first earnings report since the IPO. We're going to get the view from the CEO of Mountain. Mark Douglas joins us next. This is Open Interest. The ad tech company Mountain is out with its first earnings report since it debuted as a public company in late May this year. The results are strong as the company reported better than expected earnings and an outlook that impressed. We see analyst after analyst raising price targets on the stock. Joining us now to discuss is Mark Douglas, Mountain CEO. And Mark, great to have you here. I do want to get your take on some of the other stuff going on in media, especially Disney. But first off, tell us about the earnings, because I see Evercore ISI raising its target, Morgan Stanley raising its target, Needham raising its target, and it goes on and on.
Yeah, well, the company had a great quarter. We definitely beat analyst expectations. Adjusted EBITDA was up 92% year over year, revenue up 35%, the performance TV revenue up 35% year over year. So great quarter. We're excited. We're very bullish on our future, and just going to keep stringing together quarter after quarter. That's our goal.
It's worked so far. The shares are up now 82% since you went public, which was, what, May
22nd.
22nd.
Yeah, right before Memorial Day weekend. Then I went to a music festival after.
What festival?
I went to Bottle Rock, which is great music festival. I had a great weekend. You leave the New York Stock Exchange, and then you get live music.
It's a good little honeymoon. It's a good little honeymoon.
What more could you ask for?
Okay, so you're fresh off your first earnings report. I was reading through the transcript. You made the point that while others chase the top 1% of advertisers, we've gone the other way. I'd like to get a little bit more detail there. What does that look like, that strategy?
Yeah, so television advertising, and now we're focused entirely on streaming TV, and essentially the market that's where all the consumers are, has been this medium for the world's largest brands. And we've democratized it to make it so that any size brand, especially small and mid-sized businesses, direct-to-consumer brands, e-commerce brands, challenger brands, can now use TV to find their next customer, and can do that alongside of the other channels they've traditionally used, which are paid search and paid social. So our platform enables that. Customers just come to Mountain in order to get on television and do it in a very targeted way and be able to measure the impact.
So, what's next? You just continue to execute that strategy? Is there something you're pushing, a lever you're pushing for growth? What's your plan to continue this run? Because you've already basically doubled your stock in 2 months.
Yeah, so we continue to invest in customer acquisition. We can sense that we've gone from where we're evangelizing this as something SMB business can do to where now they're aware. And so we're just opening up the door, bringing a lot more small businesses. We have new technology coming. We effectively kind of pre-announced. One of the challenges our customers have is they don't have the production budgets that you typically think about with TV commercials. So with the advent of AI, we have
and Ryan.
And of course, Ryan. And we're partnered for tools around that we're going to be announcing in the not too distant future. We have a division of a company called QuickFrame, which is a marketplace of thousands of independent creators to help our customers build ads. And this is not just small businesses using this. This is larger businesses too who want to do more content and do it faster. And so they're just as interested.
So it's not just placing the ads, you're helping them find ways to produce the content at a lower cost.
Yeah, the stat about our business I'm most proud of is 97% of our customers have never advertised before on TV when they launch a campaign on Mountain. So, but that also means 97% have never produced a television commercial when we meet them. So we have to help them with both problems, and we've been doing that for a while.
Well, let's talk about the overall landscape that you're operating in. We got Disney results this morning, and it was a pretty dire read on the state of conventional TV. Their income from conventional entertainment TV fell about 28%, and we were just having the conversation with Peter Supino that it seems like linear TV is in a bad way right now, and there's not a clear light at the end of the tunnel. And just curious your read on the situation.
Well, I think that's true. I mean, essentially, people who still have cable subscriptions cancel them at the rate they move. Like, you don't move and then call the cable company anymore, right? You just, let's say your TV, you don't even play, you just turn on your Samsung or LG TV or any brand, and all the apps are on there. You can watch television instantly as long as you're just, connected to your Wi-Fi network.
Including Bloomberg.
Yeah, and Bloomberg, of course. Yeah. And so, but the way to think about it, I think when mobile first came about, people thought of it as something new, but it's really the same consumers just having another way to access the internet, and streaming is the same thing. Yes, their linear businesses are declining, but at the same time, the streaming businesses are growing. Their business models are shifting a bit, but overall, people are going to want, if you give people what they want in the way they want it, they will consume more of it. It's really easy. So they're just going to watch more streaming content, and all these networks will do fine.
Is the deal with ESPN and the NFL going to make it so I don't have to have cable to watch football on the weekends? Because if you don't have to watch live sports, and the NFL must be one of the most valuable leagues in the world with F1 and whatever World Cup, you know, if you don't have to watch live sports, there's really no reason to have cable TV.
Yeah, I mean, I think on streaming, people obviously still want to watch live. And so one of the things you see ESPN doing, and Disney in particular, is bringing live sports to streaming, bringing and the ads with it. And so you'll still be able to watch live. You just won't, as you said, you won't need a cable subscription to do it. And if you look at more consumers are coming into streaming with ad-supported options or hybrids, subscription and ads, than are going subscription only. So consumers have clearly decided, look, if the ads are entertaining, they're targeted to me, they're broader than just the world's 1% of the world's big brands, then that's an experience I'm willing to partake in alongside my favorite shows, my favorite sports games, and so forth. So this is going to, I think you're going to see a lot of growth in the media business in the next few years, especially as live sports really starts to find a home in streaming.
All right, Mark, great having you in the studio, especially after your first earnings day. Mountain CEO Mark Douglas, fresh out of 15,000 one-on-one analyst meetings. Coming up next hour, more earnings insight from the C-suite. We'll sit down with Stephen Yalof, the CEO of Tanger, which operates shopping centers across the United States. This is Bloomberg Open Interest.
Welcome back to Open Interest. Let's get a check on this market right now. We're just over 20 minutes into the session, and you can see it's just about an even split when it comes to the S&P 500, about 0.2% higher, 267 names in the green. Up top, this is interesting. Apple is your biggest contributor to the upside, adding 12 points to the index right now. That's after Apple recommitted and added to its commitment of how much it's going to invest in the U.S. over the next couple years. Obviously, the market liking that sign of goodwill from the company, sending shares higher by about 3.5%. Train your eyes on the downside, though. Advanced Micro Devices, AMD, is your biggest loser right now, down 5%. That's taking about almost 2 points off the index. Of course, they reported earnings last night. China still an issue for the chip maker, as it is for many of the companies in this index. Let's take a look at sectors as well. I think this is interesting, too, because you take a look, another even split, just about the same number of green bars as there are red bars. Energy up at the top. You wouldn't necessarily know it by looking at the single names here, but energy higher by about 1%. Mac, consumer discretionary, big tech, and then you take a look at the bottom, your laggards today, industrials and healthcare. That's actually a familiar sight by now. Healthcare down about 1% as well. Yeah, oil rallying more than $1 a barrel. But we're still only at 66.21 for Brent, 68.70. 66.21 for NYMEX, 68.70 for Brent. Not big numbers. Coming in the next hour, Ann Berry talks sky-high valuations, really big numbers for companies like OpenAI and Palantir. Plus, we're going to talk about the convergence between public and private markets, as well as outlet malls. This is Open Interest. $30 minutes into the trading day, we're looking at green arrows, 10 points up on the S&P 500, 80 on the NASDAQ. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. We're looking at the S&P 500 rebounding, to your point, not by much, but also not being shaken by tariff headlines. We'll talk about those in just a minute. Coming up, President Trump ramps up tariff threats with India, pharma, and chips insights, imposing an additional 25% tariff on goods from India.
And a Bloomberg scoop, OpenAI eyes a massive share sale as the AI showdown heats up. We're talking about a $500 billion valuation.
It's a lot of money, and big banks get tough on junior staff. Bank of America is pushing investment banking analysts to disclose if they've accepted other jobs.
All right, let's get to the breaking news on India right now. Just looking at a fairly long Twitter post by President Trump. The text, actually, there's a text of the order here from Rapid Response 47. An additional 25% tariff on India in response to its continued purchase of Russian oil. And to me, additional would mean that it stacks on top of tariffs that we already have there. Of course, India has more tariffs on the U.S. than almost any other trading partner. Ann Berry joins us right now, Threadneedle Ventures founder, and this is just one piece of a bigger project that it looks like the president has focused on, turning the screws on Russia through other countries. Right? He's angry that India continues to buy Russian oil. How does this play out? Does the market even care about this kind of thing anymore, or do we just sort of read the post and move on?
I don't think we read the post and move on. I think the market does care, but I think what the market is looking for is signs that some of these trade edicts are actually going to become, in effect, become permanent fixtures, right? We see even with the EU and the Japan deals, for example, promises about investment into the US is not necessarily guaranteed. And I think until the details get pinned down, it's very hard to know. I think, Matt, the piece that struck me here, though, is part of the whole pharmaceuticals narrative that we've heard. India is one of the biggest suppliers of generics to the United States. So I look at this and the first thing flashing through my mind is, yes, the geopolitical piece and negotiations with Russia, but also is just another piece of the puzzle for President Trump as he tries to get pharmaceutical manufacturing back in the US.
I know we still have to digest what is encompassed in these tariffs, as well as India in particular, the relationship to the United States. What draws my attention here is that you have Apple saying that they're going to be putting another $100 billion to U.S. manufacturing, but they're also looking to India. And so how reliable is India as an alternative to China for companies, particularly Apple, to move part of their manufacturing there?
Well, I think the problem is reliability no longer exists as a concept, right, in this world where the continuous changes in trade policy are constantly affecting the supply chain. I do think, though, rather like manufacturing in China, it's just very difficult to displace, right? This is enormous amounts of capex. It's finding not only the right hard assets. We tend to understate the importance of highly skilled, highly trained labor that works in these manufacturing facilities. And for things like Apple, these are complex products, right? You can't just up sticks and move things. So they do have their entrenchment with India. It's hard to move that, with rapidity.
And we should say it's so interesting. You're not only seeing the S&P not negatively impacted, you're actually seeing it riding higher.
Yeah, well, I mean, this was so well telegraphed yesterday and the day before. We knew essentially this was coming, and you could probably make the guess that it's going to get worse in terms of the tariff numbers, right? I mean, President Trump yesterday told Joe Kernan on CNBC that the pharma tariffs are going to start small, but then eventually go up to 250% in a year. So he's giving us his playbook, and Mr. Market just does not care. Goldman Sachs, a Goldman Sachs trader came out today and said there's a 30% chance of a probability of a recession in the U.S., which we could quibble about the percentage. But his point was, Paolo Schiavone, in a note to clients, his point was the market just can't look out that far. This market just has so much momentum, and it's just driven by, he says it feels almost irrational. What do you think about that?
Irrational exuberance.
Yeah.
We're talking about being in a bubble. That's what he's saying when you cut through the noise.
Right.
The thing I like about that note is at least a voice is speaking up and saying the risk of recession hasn't gone away. And I think one of the things that's now coming through very clearly in this earnings season is the bifurcation of the earnings performance of those companies that are being really hit hard by tariffs, and we're seeing that in industrials. And those that are continuing to see enormous growth, we're seeing that in tech and blowout earnings with the likes of Palantir. So I think when we really try to unpack what does it mean to have 30% recession risk, I think we need to look at it by sector. Right, I think the risk of different parts of the economy going into recessional downturns, we need to pass that, and we need to see what the impact is on employment in those different segments. And when it comes to stock market valuations, I've said this for a while, we're at a 0 to negative equity risk premium environment, right? And that, to me, does signal. You
mentioned Palantir as well. I'm wondering why you're comfortable with getting in at these levels.
Yes.
A lot of people are getting quite concerned about valuation. So what suggests that it could keep growing anywhere close to this rate?
And you've been in for a while, right?
No, I haven't. No, I haven't. I have been a cynic.
You have?
I have been a cynic, but
So now you're going to buy it 100 times sales?
So So I spent some time looking at this, and I thought, I've bought a very small amount. And like, this to me is like thinking about Amazon right as it went public. And I do not invest like this. I'm just going to say this is not how I invest.
This is not like
This is not what I do.
Just telling you bought a lottery ticket.
I bought a lottery ticket, but here's why. When you de-jargonize what Palantir says, they talk about ontology. I was looking at this Goldman Sachs report. I have it here. I brought it with me. Okay, try to unpack this. They talk about Palantir discussed its vision of ontology web services, an architecture that enables customers to re-platform from the building blocks of the hyperscaler stack onto AIP using its. But that's not. No one can understand what that means, right? And I look at language like that and say you've got to cut through the noise. And by the way, back to Bob, when you got reports like that coming out with that kind of jargonized prose, like, you definitely think you're in territory that's difficult. But when you cut through it, here's my perspective. I have now sat in many, many board meetings. I've sat in operating companies. And the single toughest thing for businesses to do, but the most transformational thing they can do, is roll out ERP or enterprise resource management systems. And most companies are doing it piecemeal. You bring in some SAP, you bring in some Salesforce. When I cut through what Palantir is doing, if what they're doing is really working, it is the ultimate form of effective ERP system. And if they can roll that out and have use cases that expand as they're proving in the corporate space, I think when you de-jargonize it, it is the ultimate AI-driven ERP implementation system.
By the way, I love the idea that when we get into bubble territory and an analyst writes a note about a buy on a 500 PE company, he or she just tries to confuse you for a few pages, right?
Semantics.
Let's say something unintelligible and then put a buy on it.
That's not the fault. That is the language that's coming from the company itself. But that's why I bought a lottery ticket, because I do see a world in which they are truly differentiated in a much more mainstream way than perhaps I've been imagining so far.
And great to have you here.
Thanks for having me.
We got to keep her for an hour.
I know.
5 minutes, not enough.
To talk about Disney. I know she's interested in that
I'm so
too.
keen on Disney.
But tariffs got in the way,
It did.
as they often do. Anyways, Ann Berry, we thank you so much. That is Threadneedle Ventures founder. We're going to get some look at single stocks moving this hour. We're going to bring in Bloomberg Equities reporter Nora Melinda for that. Nora.
Sonali, shares of Uber have been choppy in trading this morning, but they're now pointing lower, and that is despite the fact that the company reported a $20 billion new stock buyback and actually gave a third quarter forecast that was better than anticipated. But we really are seeing increased user frequency, but a slight miss in particular on actual ride share bookings here. Of course, we're going to hear from Lyft and DoorDash later after the close here. And sales at McDonald's are picking up, and that's at least according to last quarter's results. The company snapped 4 straight quarters of tepid growth here, and we're really starting to see its collaborations with pop culture and also those budget meals really paying off here for the retailer. And of course, we have AMD shares lastly falling this morning, and that's after the company failed to deliver a clear outlook for resuming sales in China. We know that this is super critical to its business here, being that this is the largest market for semiconductors, and the Trump administration had earlier barred some shipments of chips to China back in April before later reversing course here. But this is the second biggest maker of AI processors, so we really do have a lot of these investors really trying to parse the news here, Sonali.
Nora Melinda, we thank you so very much for keeping an eye on all of those movers in the middle of a busy earnings season, a lot of moves under the surface. And Matt, we've been talking about that additional 25% tariff on India. We're going to bring in our own Washington correspondent, Tyler Kendall, to talk about the latest. And we were talking a little earlier, Tyler, about how this has been pretty well telegraphed. Is there anything in here that actually isn't as extreme as expected? Just looking at the investor reaction in the broader market, it's not so bad.
Well, Sonali, it was widely expected. President Trump said that we could expect this so-called secondary tariff to be implemented on India within the next 24 hours. That was yesterday. And now we got this post on X outlining this new executive order that he signed for an additional 25% tariff against India. And according to the executive order, this will stack on top of existing so-called reciprocal tariffs that are already at 25%. So that does bring the levy pretty high when it does come to India. And really importantly here, it does say that this is going to go into effect within the next 21 days. So perhaps there could be some room for negotiations, as we do know that at least on the trade talk front with India, those have sort of gone off the rails at this point. We really haven't seen much progress and really a lot of frustration from the White House when it comes to this. On the Russia front, this is really the White House trying to put the pressure on Vladimir Putin to come to the negotiating table, as it appears that talks today in Moscow between between the U.S. Special Envoy Steve Witkoff and Putin did not yield any really further progress or results.
All right, Tyler Kendall, our Washington correspondent, talking to us about what we know so far. We saw the draft of the executive order on, I guess, there's a White House Twitter account called Rapid Response 47. It's mostly attacks on political opponents, but also they released the draft
updates
of the executive order there. Coming up, expanding retail access to private markets. We're going to analyze the convergence between public and private markets next. Sachin Khajuria joins us, CIO and founder of Achilles Global Management. This is Open Interest. Let's get now to high interest to look what's making headlines around the world. Later today, President Trump will announce Apple's commitment to spend another $100 billion on domestic manufacturing. It's the latest pledge by the tech giant to increase U.S. production of its products as it seeks to avoid punishing tariffs on its flagship iPhone. Remember, they already promised $500 billion in the next 4 years. A long-feared change to Wall Street's plumbing is paying off, and it's freeing up billions of dollars. Over a year after the U.S. adopted the one-day settlement, a key measure of the corporate bond trading costs is down 12%, according to Barclays. The shift to T+1 was born of meme stock chaos when a wave of settlement failures exposed the dangers of delay. But it turns out to be saving a lot of money for credit markets. Europe is slated to follow in 2027. And Carlyle pulled off a string of private equity exits in the second quarter. That helped to lift earnings during a stretch when some of its buyout rivals struggled to sell out of bets profitably. The results show that investors are finding ways to squeeze cash out of investments, even as tariff uncertainty and deal valuations delay the industry's revival.
Yeah,
Sonali?
and it's really interesting. You're seeing Carlyle ahead of the pack this year. They were trading at a tougher place, let's say, in the last couple of years, but this year up 22%, whereas many others, KKR, Apollo, all lower on the year. We're going to dive further into the realm of private markets. We are joined now by Achilles Global founder and CIO Sachin Khajuria. Achilles Global is a private investment firm operating in public and private markets. And Sachin, you spent a lot of time at Apollo yourself before leaving and founding Achilles. What's going on here? You look at the negativity behind the stocks of these major alternative asset managers. This was the flavor of the decade, it feels like, for the financial industry. Why are investors so negative on these assets?
So it's good to be back. Look, I think long term, we're in the early stages of a super cycle for private markets, and that's driven by democratization, and it's driven by demand that's coming from demographics. But in the near term, it's not going to be an easy ride. So if you look long term, you're finding that demographics are powering the needs of retirees. There are more retirees, they're getting older, and they need diversification in their portfolios. And private markets products are a way to provide that. That's why you're seeing the convergence between public and private markets. It's a way to innovate, to create new products, to feed this need. And of course, the biggest prize, the ultimate democratization, is individual retirement accounts, 401ks. The industry is $15 trillion today. You could see it getting well ahead of 20 trillion. So, I'm long-term positive on these things, but short-term, there are issues. If you analyze why there are issues, where's the problem? Private equity is kind of stuck in a bit of a timeout in parts, whereas private credit is scoring touchdowns, is playing offense.
In relationship terms, they call that the doghouse.
In the doghouse, that's right.
But it's important to
knows well about that.
Am I in the doghouse?
No,
Did you get in the doghouse? Did my significant other get in the doghouse?
Listen, I want to pull on two threads there, Sachin. Number one, the demographics. Are we getting more retirees, and when does that start to reverse, right? Because the baby boomers are going to start exiting. And number two, getting into 401ks for these private assets, it's got to be great for the industry because you don't need the liquidity in your 401k, right?
So first of all, demographic gets global, right? So that's why you're seeing private markets firms being able to raise private credit funds and deploy capital, not just here in the United States, but also in Europe and around the world. And I think the overall demographic trends are very positive. If you look at individual retirement accounts, they're used to paying relatively low fees, a few basis points for daily liquidity, daily index funds. But the performance is not always great, and certainly it's not diversified. And so the idea really is to add private markets products into that, diversify those portfolios, and you're looking at $5-6 trillion of AUM which would come in, and that's really, I think, the big prize for these firms.
But what are they going to be actually acquiring for these plans? Is it more private credit? Is it this infrastructure, real estate kind of play that you're seeing so many of these firms get into? Because to the point that you're making, private equity has been sitting on assets for what feels like forever, right?
So if you take private equity, the issue is the vintage. It's the vintages which are kind of either side of the pandemic. Those where you get, a toxic mix, really a difficult mix of issues. You have write-downs. You have a tough exit environment. It seems like the exit environment's about to open. There's light at the end of the tunnel, but actually it's an oncoming train, right? The best firms, the winners, right, they're going to be able to deploy capital today, as well as deal with these historic issues. And what you'll see in IRAs, what you'll see in 401ks is a mix of products. You'll see private credit, you'll see private equity, you'll see all of these things to enable to diversify. It doesn't mean I think you'll have a total switching, but if you have 10, 20, 30% of those accounts moving into private equity and private credit, I think that'll be beneficial for retirees going forward.
What does it mean for public markets?
Public markets have kind of been on the back foot a little bit, right? I mean, you've seen a lot of companies drop out of the public markets, but they're still going to be important.
And IPOs have not been. I mean, we just saw Wall Street bonuses yesterday. Debt underwriting did great. Equity underwriting, not so much.
And hence, you're seeing a difficult exit environment for a lot of private equity companies. But I think it's, let's say, a bit of a rebalancing. The irony is, if you have additional trillions coming into private equity firms and private markets firms in general to manage assets, that's actually going to generate billions of dollars of management fees for them. That's going to benefit the equity of these firms. And ironically, the equity of these firms is actually in the S&P. It's public, right? So you'll see a rebalancing from public dominant to kind of a mix of public and private, and this will play out over the next decade plus.
Just to understand the situation, if you got into a private equity fund in 2018 or either side of the pandemic, what are the expectations for returns by and large today?
So number one, a return of your capital. That's actually a tougher hurdle than you might think. And number two, a sort of modest return on your capital. I think if you're every fund is different, every firm is different. But if you're making somewhere around 10% for a fund that hasn't really worked out that well, you probably just move on and look to see whether they're doing good deals today. And if they're doing good deals today, and I think a lot of today's playbook has adapted to higher interest rates, to tariffs, to a different environment, then I think, you'd think that's an acceptable outcome. The difficulty is when you're not getting your money back. And that's why you're seeing the secondary market so active. You're seeing secondaries active because LPs need that liquidity. They're saying, it's been 10 years. These are 10-year funds. Right. I'm only halfway through a 10-year problem. I need to get some money now.
Pretty quickly here, because you do invest across public and private. When you look at valuations in the market today, credit spreads are very, very tight. A lot of people getting worried about just broader market valuations. Where do you stand?
I think the economy is flashing some warning signs, right? But these are amber signs. They're not red. If you look at activity, employment. And so I think the valuations are skating on thinner ice than, we might think. And the biggest issue really is the geopolitical risks and the policy uncertainty. So, I would expect some kind of correction or pullback. But unless the economy, rather than slows down, unless it just stalls, I wouldn't expect more than a modest pullback in valuations.
All right, Sachin, great having you on the program. Hope to get you back soon. Sachin Khajuria there, Achilles global founder and CIO, talking to us about public and private markets. Still ahead, his alma mater, Apollo, capitalizing on booming demand for digital infrastructure. We'll have details on the firm's data center deal later this hour. This is Bloomberg Open Interest. All right, we're looking at an S&P that is flagging, right? I mean, this is the day's trade. We were doing great, and now we're back to flat on the index. Right now, 63.01 is the level. Apple, the biggest gainer in terms of point additions. That's because it is expected to announce, or President Trump is expected to announce for Apple that it's investing another $100 billion in the U.S. In terms of the losers, AMD, after its earnings report yesterday, disappointed analysts in terms of what it could actually say about China sales. The shares are being punished, down 7 2/3%. You can see Microsoft and Nvidia down as well, which definitely doesn't help us. In terms of the breadth, 210 stocks rising, 293 down, so breadth to the downside. We're still looking at a pretty even split in terms of the sectors. About half are gaining and half are losing right now. But the big losers, healthcare, industrials, materials, and utilities, really weighing on this market as consumer staples like Tesla and consumer discretionary like Tesla and consumer staples rise in this market. When we come back, we'll talk about the consumer with Stephen Yalof, the CEO of Tanger. Tanger is raising its full-year guidance ahead of the back-to-school season and anticipates more activity. It's 37 outlets throughout the year. The CEO, Stephen Yalof, joins us now here on set in New York City. Great to have you here. Stephen, tell us about the results. I mean, obviously, if you're boosting your full-year forecast, you have a good view of the consumer from here.
Yeah, we do. And thank you for having me back on. It's great to be here. Well, first of all, I think it starts with the consumer, right? Because if the consumer is shopping, then retailers want to be in your shopping centers. And if retailers want to be in your shopping centers and they're replacing previous poorer performing retailers, all of a sudden we see this great virtuous cycle of better retailers coming into our centers, customers responding and coming and shopping these better retailers, creating a lot more activity in our centers. And all of those things are great for growing our revenues, growing our NOI, and that's led to us raising.
By the way, it runs counter to, I would have thought that because of tariffs and uncertainty, you're having a problem this year, but you beat on EPS, you beat on revenue, and you're raising your forecast for 2025. Is it just not a concern to the shoppers that go to your stores?
No, I think it's definitely a concern, but what's so interesting is when they announced tariffs in April, our traffic started to build in April. And you could say that some of the folks were responding to, hey, might as well get out and shop now, thinking that perhaps the back half of the year might be a little bit more challenging from a pricing point of view, or even from a product availability point of view. So one of the initiatives, one of our marketing department people said, hey, here's an idea. Why don't we bring back to school shopping, which I don't know if you know this or not, but it's the second biggest shopping holiday of the retail calendar. So let's pull it forward into June. It's typically late July, early August, marries up with tax-free week in a lot of the in a lot of the states where we have centers. And if we pull it forward, maybe we can take a little bit of the burden off of the consumer. They can come out earlier. They know the product's going to be there. Perhaps they'll get the best possible value on the products that they're buying.
But if they're pulling forward like that, what does it say about the future? Because tariff rates right now are settling a lot higher than what a lot of investors were expecting. Does it mean that some of those tariff pressures might be seen later, months down the road, that investors are not accounting for them today and that they could still be passed on to the consumer?
Well, I think that's definitely always going to be a concern, and that's always going to be out there. But I think there were a lot of brands that actually, they did push pricing in the second quarter. And with us, particularly in our value channel property, the consumer is looking at base price. And even if the base price went up a couple of points, it's still marked down every day. So they're getting the best possible price on the products that they want, even though the base could have gone up.
So what about the conversations you're having? Do you remember we talked to Rebecca Minkoff a couple months ago, and she was talking about how small businesses are going to feel this much worse. Are they ones that can pass on prices? How are they navigating through this? And is business just being pushed more and more to bigger brands?
Right, or you have, for the most part, very big brands, don't you?
Well, we do. But, I understand what you're saying about the smaller brands. And we do have some full-price shopping centers, and we do have a number of those smaller brands that are in these centers. And, I think you're right. I think that, at least the bigger brands have the ability to scale and buy at volume and buy larger quantities and get the benefit of better pricing, accordingly. The smaller brands, look, brands have fans. And, I had a conversation with a brand, a much smaller brand, quite recently, and I said, how are you going to treat tariffs going forward? It's always top of mind. First question we ask when we sit with any of our retailer partners. And they said, we'll probably absorb part of the pricing, but we're definitely going to pass part on to the consumer. But Our consumer understands us, they like us, they know the fit, they know what they can get when they shop with us. And I think that we're going to be able to push our pricing with our consumer without alienating them. But, I think that we're going to be able to continue to grow our business.
I guess Tory Burch is not one of the giants,
Mid-size?
not Nike.
Quite large.
Right? It's a mid-sized brand.
You can get it at Bloomingdale's.
Bigger than Rebecca Minkoff, but smaller than
Nike or something like that.
Okay.
Jimmy Choo.
I want to ask about the stock because this year's been difficult, right? I think it's down 5 or 6% year to date, but the past 5 years you're up 530%.
Can you say that again?
The past 5 years. Well, look, here's a chart. The past 5 years, this is 438%, and I think if you reinvest your dividends, which a smart investor would do, you're up 531.79%, so total return. Is that a sustainable run rate? I mean, that's just incredible growth.
Well, we've seen great growth because, don't forget, coming out of COVID, when I first started in April of 2020, 3,000 stores and every single one was closed. So getting stores open, getting brands back in business, I think was the big challenge back then. And we've continued to build from there. But a number of the things that we learned post-COVID, I think, are really important. I think that they are the big storyline that led to this growth that we've had. First of all, particularly in our outlet portfolio, the customer, is coming to shop value, but as our shopping centers became a little bit more localized, post-COVID, the demographics shifted. Secondary homes became primary homes in a lot of the geographies where we have centers. And because of that, we see our customer coming and shopping with us far more frequently than they ever did before. When that's the case, they're looking for a lot of other things in our center. And when we put a car in our parking lot, we want it to stay there as long as we can. So if I can offer you better food, if I can offer you services, if I can entertain you while you're there, then I think I can hold your attention and keep you there longer. So we've filled a lot of that space post-COVID with alternative uses that weren't typical in that portfolio. And I think that's leading to us growing rents, us growing revenues, us growing sales, and obviously the great growth that the company's had over the past 5 years.
It's a girl from Paramus, New Jersey. I know what it's like to hang out at a mall.
Yeah, I mean, in Granville, Ohio, we went to the Indian Mound Mall and Heath all the time, but this is a different experience, as you say, because you're trying to really improve everything. So it's not just, Taco Bell and an arcade. Maybe there's no arcade anymore.
Stephen, we thank you so much for joining us here on set. That is Stephen Yalof, CEO of Tanger. Now let's check on these markets right now because we have seen, as Matt was talking about a little earlier, we had a reversal. Now we're back up about 0.2%. NASDAQ 100 is still up about 0.4%. Investors loving a little Apple today because of that pending announcement around more investment, $100 billion worth in the United States. The 10-year yield at about 4.21 for a moment yesterday, Matt Miller, just a small moment. We dipped right below that 420 mark, and I'm just kind of watching and seeing how low can it go.
This is pretty amazing because we came down to that level on Friday, right? Yeah. And the equity market bounced back on Monday, and I thought we would see a move back on yields as well, but we're still holding at 420, which is a great place to be.
And it's kind of like, to your point on that, I keep freaking out over every little basis point. Maybe I shouldn't. I'm finally with you on that. Chill. Let's get a look at some stocks moving this hour with Bloomberg Equities reporter Nora Melinda.
Well, let's take a look at shares of Open Door Technologies. We're seeing shares falling for double-digit losses today, and that's after the company's third quarter forecast failed to meet expectations here. Well, really, it was a underwhelming forecast, rather. And we are really seeing this stock just taking a bit of a breather here in that rally that we've been seeing, especially as we think about the broader scope of the meme stock rally that we saw more recently. And so we are seeing a lot of analysts and investors alike just really looking for a sense of certainty when it comes to the future, whether it comes to its AI push or also how it's going to navigate the uncertain housing market and the other macro environmental challenges. But also looking at shares of Snap. Of course, we know this is the owner of Snapchat here. We're seeing shares also plunging for double-digit losses here, and that's after a slowdown in the company's advertising revenue growth. And this is, of course, due to a glitch in its ad buying tool specifically. We saw growth dropped to 3 to 4%, and that's from 9% in the first quarter here. So not a great day here for Snap. But lastly, I want to take a look at Super Microcomputers. Now, this is the worst performing stock in the S&P 500 last I checked. It lowered its fiscal fiscal revenue forecast here, and this is really raising questions about the company's ability to capitalize on demand for AI equipment with the latest NVIDIA chips here. We have Bloomberg Intelligence saying that the outlook implies a competitive pricing environment, and they're pointing to Dell there, Sonali.
Nora, go ahead.
All right. Well, no. Well, we both thank you. Sonali and I both thank you.
We do.
Nora, Melinda. Let's get to a story on the Federal Reserve. President Trump has been saying for days now that he's going to name someone to fill the seat on the Fed board left vacant by Adriana Kugler. That's what we heard from him on Sunday night. He said it again last night. What more do we know about the fact that the president is going to fill this seat? He said by the end of the week.
Well, our reporters Anne-Marie Horton and Saleha Mohsen are reporting that the president's advisors are suggesting and urging him to appoint somebody temporarily to the seat until Kugler's term is up at the end of January, giving him more time to decide who he wants to be the next chair of the Fed. In theory, this person would only serve for a short period of time, and that seat would still be open at the end of January, so he doesn't end up with the dilemma of not having a seat available if Jay Powell wants to stay on. The only problem is that for the president and for a potential nominee is the time it does take to get confirmed. Even if the person's in government, it would be rocket confirmation if they got that person in place by September 17th. The story says that they're looking for somebody who's already in government, who's already been confirmed to something, so it would make it much easier. But there are only 4 meetings left before the end of her term. September 17th is coming up very rapidly. The Senate doesn't start work again until September 2nd.
Now, hang on, can I just ask, this is to me a little bit puzzling. The fact that Kugler left, we still don't know why she left, right? President Trump suggests it's because somehow it's because he agrees with her on rates. No. That's his suggestion, at least. Yeah, but I've heard him say it at least twice.
But her recent speeches, including the last one that she gave in the middle of July before she missed the July Fed meeting for personal reasons, said that it was still time to hold interest rates.
Well, also, if she agreed with him, she wouldn't necessarily leave. She would just dissent, right? And then I'm puzzled by the term temporary. So her term is set to expire January 2026, in a few months from now.
Yes.
Does the president, is it his choice to appoint someone to temporarily fill her seat, or could he somehow pick someone that's going to have a longer term to fill her seat?
Right. What happens to the temporary?
Isn't temporary the only way he can?
No, you can't do a temporary recess appointment as they do in a number of other categories, and the president has done quite often with the people that he's firing lately. That doesn't apply to the Fed. So the only thing they can do is nominate somebody and get them confirmed, and then the question is, how fast do they get them confirmed? And then their term would expire at the end of January, and that. So
temporary is the only way you fill this seat right now.
Well, he could nominate somebody that he tells the Senate he would like to nominate again, and they could do both nominations at the same time for the remaining 4 months and for the next 14-year term. They would also, if that person were to his choice for chair, they'd have to be confirmed a third time. All of that, in theory, could be handled sort of at the same time.
Right. How likely is it that they do that? Because that is a scenario Besant has said could happen before.
Well, the problem is, according to the people that Anne-Marie and Saleha are talking to, that the president hasn't decided yet on who he wants to be the chair. And so it might make it better for him to have more time to think about it. Now, their story says that he is meeting with his aides today to talk about this, so we could get some sort of official announcement on the president's timetable, which is by the end of the week.
Right. I mean, he said on Sunday at Andrews he would do it in the next couple of days. And then last night he said from the White House that he would do it by the end of the week.
Yeah, well, there's a lot riding on this for Wall Street because the idea of who will chair the Fed next is very important. Who takes Kugler's seat on a short-term basis isn't really important. The chair is... The rest of the Board of Governors, until Mickey Bowman and Chris Waller dissented last time, has voted along with the chair every time since Powell's become the chairman. And so it's unlikely that this person would disagree with the chair and by that I mean there's a very good chance that Powell would vote for a rate cut in September too if the data keep going the way they are. And with only 2 dissenters now, even if he didn't, that would make 3. That's a difficult position for the Fed chair, except that he's leaving anyway. So I'm not sure what you
leaving
get.
as chair, not necessarily leaving.
I'm not sure what you get other than you get the full complement of Fed people voting, but it isn't going to change any decisions. And that person will get to speak at the Fed meeting, but as somebody who is just coming in, would they carry enough influence to change anybody's mind?
Boy, it's time to sharpen your pencils on Fed technicalities.
Yeah, it really is time to start looking.
That's why they pay me the little bucks here to read through the Federal Reserve Act.
That's why we love bothering you, Michael McKee.
Yeah, thanks for joining us. Michael McKee there, Bloomberg's international economics and policy correspondent, talking to us about President Trump filling this seat, as he said he was going to, by the end of the week. Coming up, President Trump ramps up his tariff blitz, and he continues to target India. This has been really in his sights for the past couple of days, and we'll talk more about it next. This is Open Interest.
Now, the United States will add a 25% tariff on India in coming weeks. That's due to India's continued purchases of energy from Russia. Joining us now is Bloomberg's Washington correspondent, Tyler Kendall. And you look at the current approach that the Trump administration is taking to India. What can they do at this point to swiftly bring that 25% rate down?
Well, that's a really interesting question, Sonali, because we have to keep in mind that this additional 25% tariff is just that. It's additional. It's expected to be stacked on top of the so-called reciprocal tariff rate of 25%, though in this executive order it says that this additional rate won't go into effect for another 21 days. So perhaps there is room here when it comes to negotiating it down. This 25% new rate is really tied directly to India's imports of Russian energy supplies. And if you look at the data, India imports about 37% of Russian oil exports, but those barrels are really expected to be diverted elsewhere. They're still expected to go into the marketplace, and that's why our analysts at Bloomberg Economics say that this is really more about the trade negotiations for this White House when it comes to this penalty against India that President Trump has really been threatening at this point for weeks, as we've seen these trade talks sort of go off the rails, which has been really interesting because India was one of those countries that was long prioritized. You'll remember Prime Minister Modi was one of the first foreign leaders to come to the White House and meet with President Trump. India had offered a range of concessions early on, like pledges to boost U.S. LNG, for example, but we've really seen those talks deteriorate in recent weeks. And it appears, Sonali and Matt, that one of those red lines really does have to do with opening market access when it comes to U.S. agricultural products. That does appear to be a sticking point in these negotiations that at this point neither side can come to an agreement to.
It also looks like, Tyler, the White House has, in a sense, changed its stance on who can buy what oil. I remember after the U.S. bombed Iran, Anne-Marie Horton asked President Trump about China buying Iranian oil, and he said, no problem, keep buying it. We don't care. Buy as much as you want. And then when Scott Bessent and Jameson Greer went to negotiate with China, they said one real problem they had is that China is buying Iranian oil. Well, the president said they could do it. Have they changed their stance on that and on India buying oil from Russia?
It does seem like there's been a shift, Matt, and you'll recall, since you mentioned the Treasury Secretary and Jameson Greer in Stockholm, the Treasury Secretary was asked directly whether or not they would impose a so-called secondary tariff on China. And he said if they want to keep importing sanctioned oil, then they're welcome to do so, but they are going to end up having to face a higher rate. This is something that has long been discussed within the administration, and now we're really starting to see it come to fruition here. But one thing is clear is that the White House has grown very frustrated with this Kremlin and trying to get them to the negotiating table. And we are seeing that today as talks seem to be concluding between the special envoy Steve Witkoff, who is in Moscow, and who did meet with Russian President Vladimir Putin. We did get a sort of a readout from the Russian side that said that good signals were exchanged, but it is clear that nothing really tangible or concrete came from that. And Matt and Sonali, that came after our reporting that Russia was really trying to stave off these so-called secondary tariffs. They were thinking about potentially floating an air truce to try to get the negotiations going and trying to not face economic penalty. But at this point, it doesn't appear like any progress or substantial progress was really made.
All right, Tyler, thanks very much for joining us. Tyler Kendall there, our Washington correspondent, wrapping up some of the tariff news that we've gotten and expect to get throughout the day and throughout the week. Coming up, Apollo is capitalizing on the boom in digital infrastructure with a new purchase. Details on the data center buy in today's Wall Street Beat next. This is Open Interest.
And it's time now for the Wall Street Beat. Apollo agreeing to buy a majority stake in the hyperscaler data center developer Stream Data Centers, the alternative asset manager trying to capitalize on booming demand for digital infrastructure and also kind of on an acquisition spree sort of its own. Joining us now, Bloomberg's finance reporter Catherine Doherty. How is Apollo kind of comparing with what others are doing in this industry? Because this is definitely the flavor of the last couple of years.
Yes, alternative asset managers like Apollo, they're all over. They're spending big money on data centers, on data providers. They're aggregating some of these numbers. And this is as the rise of alternative and artificial intelligence is spurring the demand for power and also for the data that's underlying the power. So we've seen this announcement today from Apollo. We've also seen Brookfield and earlier even Apollo agreeing to buy this Argo Infrastructure Partners, and that's investing in digital infrastructure, renewable energy. So this is really just kind of the next step and a big theme that we're seeing across the investment space.
I would love to see how the contract works out, right? Because do they have to pay for the power? The price of that is probably going to rise. Do they pass that on to the customers? I mean, what kind of margins do you think you get at a data center? I would imagine they're razor thin.
Own so many of the capital stacks now. Like you had, to Kat's point, they were buying a digital infrastructure renewable energy company before. And so similarly, you have KKR looking to buy the energy as well as the data center. And so if you could own both, could work out.
Absolutely. And I think that they're both users, and then they're seeing that their competitors, this is going to be a rise of demand, that they see other customers that will want to buy in and need these data centers as the use of artificial intelligence just continues to grow and to build upon itself. So even if these contracts, I think that's going to be something that gets sorted out as we continue. But Apollo is saying we see this as a potential use case that is not going away.
So, okay, Digital Bridge is a good example of this. Their revenue almost doubled, almost tripled, really, from 2022 to 2024. And they were unprofitable in the first few years, but have turned to generate hundreds of millions, let's say, in the last 12 months.
Of revenue?
Of profit.
Oh, their profit?
Yes.
Okay.
Yeah. I found you the numbers.
Very good. All right, Catherine Doherty and Sonali Basak, thank you so much. Coming up tomorrow, Morgan Stanley's Mike Wilson joins us, as well as former Dallas Fed President Rob Kaplan.